we want to address IIFL's earnings. NII growth up 39%, the profits at 490 crore rupees. Kapish Jain is the Group CFO at IIFL Finance, joining in to discuss the numbers. Thanks much for taking time out. A strong loan growth is what you've reported than the 25% that you had spoken about in FY25. Is it time to revisit your guidance?
The loan growth has been fairly fast because of the environment which has helped you to enable that particular growth and catch that market. And we have expanded very quickly. We have expanded across the geographies, across our products and businesses. With a branch-led expansion model, we have been able to taper to that growth and get to that number. And across products. So gold, for example, gold prices had held fine. With the gold price holding fine, you are then able to monetize business and get to a larger scale. In the housing finance as well, we closed around 260 branches in the last March 21 onwards, March 22 onwards till now. That has also helped us in getting to a better scale. Microfinance, the regulatory element moved away, and that is able to help you in getting to a higher growth number in businesses. So all these elements supported by the environment has helped you to grow to a higher number. We stick to our growth CAGR target of around 25% because over a long period, many of these things settle down and you have to work in line with what the market can provide. And therefore, over a long period of maybe around 2 to 3 years target, we stick to our 25% CAGR growth.
With the growth you are posting, do you think the target of AUM of 100,000 crore would be achieved by FY25 or will it be achieved much before than what you've guided?
No, we don't know. So as I said, if I just give you a perspective over the last 5 years, when we had COVID, you had liquidity crisis, and you had interest rates also picking up as well, we grew at a CAGR of around 23%. And while in the recent past you see higher growth, you don't know what challenges can come in. There could be many unknown events that can also come in on the way. So therefore, keeping all those unknown factors as well, in spite of you being ready and you being able to deliver, we still believe that we want to focus on the 25% CAGR growth and then see how things evolve.
And your yields have improved in home loans and gold loans. What does this indicate about the competitive intensity in these segments?
No, so if you talk about the gold loan, in gold we have expanded, and with our expansion we are able to get into markets where the competition intensity is lower. Today, almost even that number holds that 65% of the market is unorganized, where the customers are charged far higher rates. They could range between 2 to 3.5 to 3% per month. Relative to that, we are almost like half to that rate. And if you're able to then show your presence, get to that comfort with your customer, show your loyalty, and get that confidence from your customer, you're able to monetize and source your business. And with that kind of objective, we have been able to grow ourselves into those under-penetrated and relatively under lesser competitive market. Competition intensity in the organized space has been there, and it has marginally come down because people have realized that if they try to offer some very aggressive pricing, it will not help them in making money, because while on one side you might see that it's a very high yielding business, on the other side this business requires a lot of operating investments with regard to your CCTV cameras, security at the branches, very high technology intensive vault, because you don't want to get any kind of a risk with regard to any fraud or any looting which can happen. So all these operating expenses also beats up your pricing, and therefore you need to make sure that you're getting a decent yield to run that business, which is what people have realized, and therefore that element of aggressive pricing has come down. In the housing finance space, we have also looked into elements where we can get better yield, a lower ticket business which we can potentially do. So if you see, our volume of business transactions have actually has gone up. Our overall ticket size have marginally come down, and with that kind of shift, you are able to then get a higher yield or a better yield. And obviously, we've been able to pass on some of the yields requirement from overall market perspective, because rates have been going up over the last 12 months. So that has caused the yield beef up as well.
So given that you have 50% of your loan book in fixed rate, when the rate cycle turns, could that be beneficial for you?
So, now, which are the fixed rate businesses? The fixed rate business is largely the gold loan business, then maybe the microfinance business. But then these are short-term products. They're products of around 2 years tenure. Some of them run off sooner as well. So in a 2-year cycle, when the rate cycle starts coming down, the rate cycle will come down only gradually and only in your incremental borrowing. So on a similar trajectory, while the liabilities will slowly and gradually come down, the asset shift will also happen at a lower rate as well. So that way, I don't think there's going to be a big difference or advantage that can come in because we are not lending too long. And we are lending long in the housing business, but the housing business is all floating rate. But bulk of it is floating rate business. So I would believe that as the interest rate cycle moves, the benefit of that passing on doesn't really come with regard to holdback as well.
All right, thanks so much for taking time out. Good to have you joining in on your quarterly performance.